I'm Charlotte McLeod with investingnews.com, and here today with me is Leigh Goehring, managing partner at Goehring and Rozencwajg. Thank you so much for being here. Great to have you.
Oh, thank you, Charlotte. So it's great to be here.
Really good to be catching up with you after quite a while. And today I thought we could go through some of the themes that are covered in your latest quarterly report. And where I thought would be a good place to start, just because of its price action, is with gold. So the report actually came out all the way back in August when gold was still at about the 2,500 level. So I think that shows just how quickly it's moving right now. So starting with the gold price, is this rise sustainable? What are you seeing there?
Oh, yeah. In fact, we're a believer that we have just entered into a massive bull market in gold, and the underlying fundamental reasons for that are the fact that we over the last 15 years, ever since the global financial crisis, we've printed so much money, and we've done a lot of historical research on the relationship between monetary bases and the dollar value of gold that governments hold and things like that. And in fact, it's interesting. Back in May of 2000, I was profiled in Forbes magazine, the old Forbes magazine. It was still owned by Malcolm and run by Malcolm Forbes, and I was interviewed there about commodities, and they asked me what my favorite commodity was. And you always have a tendency not to talk about gold because you don't want to be branded a gold bug and things like that. But they kept asking me, like, what's your favorite commodity here we were in May of 2000, and I said, I have to admit it's gold. And they said, well, why is that? And they said, well, because the way we model gold relative to money says that we can come up with a gold price of $2,500 an ounce. Now, mind you, when that interview took place back then, gold was $275 an ounce. And, it's interesting. I got a lot of listening, a lot of criticism over that, because that sounded like an outrageous prediction. But the thing is that what happened in the next 10 years? Gold ran to 1900. And so even though 2,500, my target price wasn't reached, it got awfully darn close. So that shows you that there is some validity to the way we looked at gold prices relative to money. And we can value in other ways as well. We try to. But if I were to use that same valuation methodology today, I can come up with gold anywhere between $15,000 to $25,000. And everyone says, "Oh, that's crazy. How can that be?" But it's the same valuation technique I used back in May of 2000. And it's interesting that you could say, "Wow, that again, that can't be." But I would say that the multiples that produced those price targets have existed in the past, and primarily in the late 1930s and in January of 1980, when gold spiked to $850 an ounce. So can it happen this cycle? I think it's going to.
Okay, so not only is the price sustainable, it possibly has quite a bit further to go. I wonder, looking forward into 2024, 2025, a little bit shorter term, do you have thoughts on where the price might go in that time horizon?
I think it's going to be it's going to continue to surprise the upside, and there's a couple reasons for that. If you look at the history of the behavior of what Western investors do, they always sell gold when real interest rates are rising, and they always buy gold when real interest rates are falling. And the classic example of that is from basically 2016 to 2020. Real interest rates fell by almost 2.5% to 3%. Now, most of that was because inflation came down, because interest rates were basically zero during that time period. But the funny thing is what happened? Western gold investors, if you monitor the behavior of what they do through physical gold ETFs, so there's about 18 of them on a global basis, so you can aggregate them all together. They accumulated almost 2,000 tons of gold. And since the end of 2020, when we were on this period where real interest rates rose by almost 3 to 3.5% during that time period, what did Western investors become looking at those same physical gold ETFs? They liquidated over 1,000 tons of gold. So the thing is that what's happening now is we've seemed to have entered into a Western investor gold accumulation cycle. For example, just in the last 4 months, starting back, I believe, in March of this year, Western investors swung from being net sellers of physical gold to being net buyers of physical gold by about, I think, almost 400 tons. So the thing is that we now seem to be entering a buying cycle, and it's going to be driven by the lowering of real rates, which we're seeing. The Fed has already begun to lower rates, and ironically, inflation has begun to creep higher. So the thing is, as real rates come down, Westerners are reappearing to the gold market, and they have a long, long way to go. And I'm sorry, I said 400 tons. I think I meant 40 tons. They've only accumulated 40 tons. So the thing is, will they accumulate 2,000 tons on this up cycle as real interest rates increase? Yes, I think they're going to. And we've seemed to have entered that phase, and then you throw on top of that the aggressive gold behavior buying of central banks, and I think the gold is just going to continually to surprise to the upside. Now, what it does in the next 2 weeks, the next 2 months, I don't know, but I believe that any period of price weakness that you see, you should become a gold buyer.
Okay, so we have this strength and demand that you've outlined there, but in the report also makes a point, and I'm really glad that you addressed this question. Gold stocks, it's a different story there. The report mentions they've never been cheaper, and I know that was 2 months ago. Is the situation still looking the same now? How do you see the gold stocks at the moment?
Yeah, I still think that gold stocks are radically undervalued right now, and it's because obviously they've all become very, very profitable, and yet it's not reflected in the price. And what's so interesting about that is that you have a tremendous opportunity there, and investors, as of today, are still not taking any advantage of it whatsoever. Just before I got on the call, Catherine, I checked the GDX, which is the Van Eck Big Gold Equity ETF. And what's so interesting about that is that the number of shares outstanding in that gold ETF continue to contract. And what's so fascinating is that, since gold broke out back at the end of March this year, when it went through 2,100, and now it's almost 20 to 25% higher, that the open interest of the GDX gold share ETF is now fallen by about 10%. And what's interesting, it continues to go down. So what's so fascinating is that Western investors, instead of becoming more excited as the higher the gold price goes, they're becoming more bearish if you're looking at their behavior in their gold stock accumulation. So the thing is that's going to change. I have no doubt in my mind that we'll wake up one day and all of a sudden people will say, "Oh my God, I can't believe how cheap gold stocks are. I've got to own them." And we'll see that open interest surge. However, there's even when we wrote that piece, what was about 3 months ago, about how cheap gold stocks are, and they're about as almost as cheap on some valuation metrics as they were back in back in 1999. And mind you, when they were that cheap back in 1999, if you had bought the Huey index, the Amex Gold Bug Index, which is the history that we have to use that because that's the history going back that far, that went up 30-fold in the next 11 years. 30-fold. And you are being given that same opportunity based upon their cheapness today, and investors have no interest. In fact, they have a negative interest. It's absolutely fascinating.
And this is probably the key question. I don't know if you have an answer. Why is there that lack of interest, and what could bring that turnaround that you see coming, where people come back and they recognize that the gold stocks are a real opportunity?
I think what we're living through, and I've always said that we're living through the 1970s. I grew up in the 60s and 70s, so I vividly remember what the 1970s were like. And it started out very similar to what the period we're going through right now, because people forget from like 1969 to 1972, that was the Nifty 50 craze, and the Nifty 50 craze is very similar to the tech craze several years ago, and now the Magnificent Seven. Very, very, except this time it's narrower. But At the same time, the financial craze was going on. It was taking complete interest away from investing in the natural resource space, including the gold space. It's interesting. Nixon took the U.S. off the Bretton Woods gold exchange standard in, I think it was summer of 1971, and gold ran, but the next 2 years running from 35 all the way up to 135, and yet people paid very little attention because they were investing in the Nifty 50, just like they're investing in the Magnificent Seven today. We're talking about the GDX open interest going down almost every day. The QQQ, which is the NASDAQ 100 ETF, the open interest in that goes up every day. And, obviously the capitalization of the gold industry is tiny relative to those stocks. So when the open interest goes up, that requires a lot of money. It's got to come from someplace, and it's coming from all the natural resource stocks areas, including the gold stocks. That will change, though. But the thing is, I'm convinced it's going to change, and that's where the opportunity is today for people that are willing to take advantage of it.
Right. And I appreciate in the report, it goes into some of the questions investors might have about the gold stocks, concerns they might have, like, are their costs too high as we still have inflation? Is there something else that might be a problem with these companies? Maybe what would your response be to investors who have concerns like that?
Yeah. Charlotte, I agree with a lot of that. In fact, I'm going to say on a long-term basis, you don't want to be a gold stock investor. And it's interesting if you go back and you look at the history of gold stocks, say, just go back and look at the history of Newmont Mining or Barrick over the last 20 years versus like a BHP. They've been miserable performers. And there's a very good underlying reason for that. But the thing is that that is to say, when gold prices rise and you believe that we're going to have a sustained bull market in gold price, you want to own these shares. And that's probably the only time you want to own them. And the reason why gold stocks are on a long-term basis are lousy investments, especially relative to the BHPs, is that they have short reserve lives. It's a geological phenomenon that can't be escaped, that most gold deposits are only somewhere between 10 to 20 years in their lives if you mine them, in a an NPV maximizing way. And so the thing is that if you're a gold company, it means that every 5 to 7 years, I've got to go out and reinvent myself. I've got to replace those ounces that I'm producing, because if I don't, in 10 years, I wouldn't exist. So they're under that pressure all the time, which of course, if I'm BHP and I've got iron ore mines that have 100-year mine lives, or I've got Escondida, which is basically going to be 100 mine life, something like that, I don't have to worry about that. However, when the gold price goes up, earnings will go up hugely. Investors will get very, very excited, and gold stocks will be market leaders. And I think that we have that in front of us.
Okay, I think that's really important context. So thank you for going into that. And before we move on, I want to add just a small question about silver. We don't have to spend too much time, but we have gold really on the move, silver also on the move, but it's well off its all-time highs, unlike gold. So just briefly, your thoughts on silver, what's next for the price?
Yeah, we have we've done a lot of research on this topic, Charlotte, and it's very interesting. And most people don't quite understand it, but it's a phenomenon that's being repeated right now again in this gold bull market. In that, people have a sort of a belief, which is incorrect, that silver, strong precious metal bull market, silver will lead. And it turns out that nothing could be further the truth. You go back from 1971 to 1973, that huge bull market in gold, silver lagged the entire time. You go from 76 to 1980, silver lagged that huge bull move. From 2003 all the way to 2010, silver lagged most of that way. And from 2016 to 2020, silver lagged almost the entire way. However, what does happen with silver is that after lagging and lagging and lagging, then it stages a furious catch-up rally. It did it in 73, 74. It did it in the late 79, 1980, obviously spurred on by the whole the hunt silver squeeze. It did it again in 2010, 2011, and it did it in the summer of 2020. Each time, silver will have somewhere between 150% to 200% move in a a 3 to 6 month period, and catch up all its underperformance with gold. Now, when that happens, you know that the gold bull market move is ending. However, silver, this is proof that this gold bull market has legs. Silver's lagging, like you correctly mentioned. It's always lagged, and I want it to lag. And if you're a silver bull, you get very, very frustrated because say like, why is silver lagging here? Because it always does in a gold bull market. However, be aware when it plays that when it stages that massive catch-up rally, that will be the end of this gold bull market. And I suspect that's not going to happen for a while. So that's just an observation I have from silver. And and like I said, the last time silver staged this furious catch-up rally was the summer from May to August of 2020. And then what did gold do? It spent the next 3.5, 4 years doing nothing, actually trading down. So the thing is that I think it's a healthy move that silver's lagging right here, and it will continue to lag, and silver bulls will be frustrated. But I say to people, just invest in gold. And if you want to get really, tactical, is that when you believe this gold bull market's over and silver is lagged by huge amounts, put all your money in silver, and it will stage that catch-up rally.
Okay, so there's a time for silver, maybe not quite right now. Do you find that this ties into it feels like there's more and more so an instant gratification thing that people want, which doesn't really seem to work in the resource sector so much.
Yeah, that's true. And before we leave gold, Charlotte, I want to bring up one final point, which is going to be this is going to be the underlying event that happens. It's going to be the black swan in the gold market that really, really changes people's perception of gold. We are on the verge of a monetary change. And I don't know if you read our letters. We always say that historically, when you've had these huge commodity bear markets, which have been accompanied by massive fiscal and monetary expansion, that have been accompanied by huge speculative booms and binges in financial assets. Every time we've had that, the late 1920s, the late 1960s, the late 1990s, that they've all been accompanied by huge changes in the monetary regime. We are going to have a monetary regime change. It's coming up very fast. We don't know exactly what it's going to be, but just like what happened in each one of those periods before, 1930, Britain went off the gold standard forever. Roosevelt devalued the dollar in 1933 by 60%. Raised the gold price conversion from 20 to 35. 1971. It started in 1968 when Johnson removed the gold backing from the dollar when the U.S. was running out of gold. Nixon took the U.S. off the Bretton Woods gold exchange standard in 1971. Massive monetary regime change. Late 1990s, the Asian currency crisis where like the Thai baht, the South Korean won, the Indonesian rupiah, they fell by 90%. Then what they did is they all pegged them at artificially low rates, and they all swung from becoming countries suffering from current account deficits to running massive current account surpluses, including China. Again, it was one of those events. It was a monetary regime change, massively bullish for gold, like the other two periods. So we're on the verge of a monetary regime change. What it's going to be, I'm not so sure, but it's going to happen, and it's going to be massively positive to gold, and it's going to be massively positive to hard assets and commodities in general.
I know you said we don't know what it's going to look like. It's really hard to say, but do you see it tying into what's going on with the BRICS? And I ask mostly because I know we had the summit recently wrap up. So any thoughts there?
Yeah, that's one of the theories, and it's gaining traction. It could very well be, in the sense, obviously, the world's bad guys, Russia, China, Iran, North Korea, they would all like to be able to trade outside of the dollar. Everyone resents the dollar reserve currency status, and for good reason. So they would all like to set up a monetary system which eventually, evades the use of the U.S. dollar. And one of the theories is that, for example, China has approached Brazil, and Brazil's accepted. They're going to sell all their iron ore and they're going to sell all their soybeans to Brazil, and they're going to receive renminbi. They're not going to settle it in U.S. dollars. They, China has approached the Saudis and said, we would like to buy your oil, but we'd like to settle that in renminbi. Now, the Saudis have said, they've been coy about it. They said, well, we'll think about it. But, even companies like Total have agreed to denominate their LNG sales, liquefied natural gas sales, to China in renminbi. But the question is, China's got a closed capital account. So if I'm Brazil and I've got all these renminbi, what do I do with it? I can't go to their central bank and exchange it for something else. So one of the theories that's emerging is that those those current account imbalances, which will wind up at a financial imbalance, they'll be settled in dollars. So what will happen is that Brazil will take those renminbi that they don't need, they go to China, and they will settle them for gold outside of the capital account. And so that seems to be gaining legitimacy as a potential. Now, whether that's the monetary regime change that we're talking about, I don't know. But the BRICS would be very interested in given their resentment of the use of the dollar, that's something that they would be very, very receptive to doing. And it's interesting. The people that would be potentially part of that, countries like Singapore, India, Brazil, their central banks have all become have become gold accumulators. So is there something behind that? Will that be the monetary regime change? Could be.
I know when we have these kind of conversations, people tend to start thinking, okay, is this a death of the dollar scenario, or is it more, it lessens in importance? Any comments there that you would share?
Yeah, that's interesting because we sort of equate a monetary regime change with a loss of the dollar's status as a reserve currency. But the funny thing is, what's interesting is that none of that has been true. Roosevelt devalued the dollar in 1933 by 60%. The U.S. That's when the U.S. Dollar started its massive ascent as the great global reserve currency. Nixon took the dollar off the Bretton Woods gold exchange standard in 1971. The dollar ratcheted up again in its reserve currency status, and all the financial crises that occurred in the late 1990s, including Russian defaulting, things like that, that all increased the dollar reserve status one notch higher. So I think what could happen is that the dollar could still be the reserve currency, but it could still be devalued in other ways. How would it be devalued? It'd be devalued against gold. I mean, each one of those reserve currency, the dollar stayed the reserve currency, but it fell relative to gold. So maybe that's how it will be. It'll stay the reserve currency status, but it still will be devalued relative to hard assets, including gold.
Okay, I'm glad you brought that up. Anything else on the gold side, precious metals that we should go over before we move on into more of the energy section?
Yeah, I think one of the interesting things about gold, and we wrote a fascinating essay about this on a couple years ago, and I think this is so important especially for retail investors, is that if you were to look forward to the future and say we had a hypothetical dinner party in the last week of December of 2029, there's going to be the tables are set up. There's going to be two groups of tables in that dinner party. One table, people are going to be sitting around and going to be very dour, scratching their head. All they're thinking about, oh my God, what happened to me over the previous 6 years, 7 years? The other table, everyone's going to be very jovial. They're going to be saying, waiter, bring me more champagne. It's time to celebrate. What is going to be the difference? It's going to be the underlying differences between one table and the other. It's who owns the gold. The people that have significant gold holdings by the end of this decade are going to have significant control of their financial futures. The people that don't are going to be struggling badly. I think that's how severe, we talk about monetary regime changes. The gold bull market is going to happen because there's going to be all sorts of black swan events that are related to the fact that global central banks' balance sheets are tenfold bigger than they were just 15 years ago. That all these type of things are going to happen, and they're going to be all positive for gold, and they're going to be positive where everyone else is crowded into the Magnificent Seven and bonds, funds, and things like that. So I think that if you're a retail investor, try to own as much physical gold as you can, and physical silver if you want to. Both will be good. But I think we're reaching near crisis proportions on this, and I really do believe this. Which table do you want to sit on at the end of the week in December of 2029? Do you want to be popping champagne corks, or do you want to sit there and just be wringing your hands and say, "Oh my God, what happened to me?" And gold will make the difference.
One final thought there on the gold and silver and accumulating physical metal. How would you think people should balance, prices are very high right now. How should people balance these high prices with, they have to accumulate as much as they can in the near term if they haven't already?
I think what you should do is half physical. And when I say physical, that means you can buy the physical ETFs. I'm not a big believer. There's a whole conspiracy crowd out there that like the GLD does not own the physical gold, and I don't believe that. I think they do own the physical gold, so I think that that's a valid way to invest in physical gold through the GLD. And I would think that you should also invest in some gold stocks. So I would say put 40% in gold stocks and 60% in the physical metal, which could include the GLD.
Okay, thank you for going over that. And I'll move us over now to the energy side. And where I wanted to start there is with uranium, which is a favorite topic of our audience. So prices started the year strong. We saw a pullback over the summer, kind of seem to be consolidating right now. What do you think is behind that pullback that we've seen there? I've heard that utilities right now are reluctant to buy. Maybe they're looking for lower prices. What are you seeing?
I think what happened in the uranium space is that the hedge funds, which you know over a year ago wouldn't know what uranium was. And the idea if they ever thought about nuclear power, somebody say, well, there was one thing called 3 Mile Island 35 years ago that happened. That was very bad. Or there was Fukushima. So no one knew it. However, the uranium price started to really take off. So they all had to become experts in it right away. And I found it kind of amusing. There was a interview on Bloomberg where these two hedge funds were chattering back and forth, and somebody said, "Oh well, I love the uranium market here. It's switched from structural surplus to structural deficit." And of course, that's lifted right out of our letter, that line. So the thing is that they crowded into it. It became popular. They all had to own Cameco and things like that. And then the uranium price stopped going up, and it's pulled back here. And so hedge funds do what they have to do is that when it's not going up and you're not getting instant gratification, you have to sell it. And I think that there's been a lot of speculative money liquidation in the uranium space that started back when uranium prices peaked in January of this year at $106. We traded as low as 78. So that I think has been the primary source of the underperformance, especially in the equities and things like that. You are right, though, about what the utilities have done is that they have, they didn't want to chase the uranium price, and now they're all believing the uranium price is going lower, and so. Well, I believe what's happened is that they have turned from being buyers. They're not obviously not sellers, but they're just sitting on the sidelines waiting. So something will happen. The underlying fundamentals of the uranium market are incredibly positive on a long-term basis, and I think that they will come back in. The uranium market it's very interesting. People haven't commented on this. The thing with the structural deficit, it's only getting worse and worse and worse. And one of the reasons is that these new sources of supply are failing to materialize. And of course, the biggest source of new supply failing to materialize is both 2020, 2025 is from Kazatomprom. Kazatomprom had to lower their 2025 production estimates by I think like 11 million pounds or something like that. Which, mind you, we did a great uh, webcast the day before, I'm sorry, a blog we put out where we said that Kazatomprom is going to vastly disappoint. So you've lost that Kazatomprom production, and I'm convinced, like for example, the next big slug of production is going to be the Arrow project up in Athabasca by next year. That's a great project. It's going to happen, but they're talking about coming on in 2028. I don't think that's going to happen. It's going to be probably the early 2030s. So you have this, and the demand side just keeps creeping higher and creeping higher and creeping higher, and we're not going to get any big sources of supply. So at some point we got to wake up, and the wake up's going to happen when prices have to jump higher. So the uranium bull market it is only in the first third of happening, and you still have two-thirds left with an underlying positive backdrop, which is different than we were talking before. It's different than what's happening in the copper market. So where the fundamentals there, we believe from a standpoint are deteriorating. The uranium market, from the demand point, it's actually strengthening. So.
Right. And we'll go over to copper, but before we go there, just a couple of follow-ups on uranium because we went over so many things there. So you mentioned the fundamentals are so positive, and it seems like this year, really even in the past few months, they've been getting even more positive with all of the data center demand, the companies like Microsoft, Amazon, Google coming in saying they want to use nuclear power for their data centers, which is all related back to AI. So any thoughts on how that is going to impact the market, which was already in such a good position?
Yeah. Oh, in fact, I would say these are the type of things. These are We'll talk about the reason why this is happening. But all these positive announcements, and I don't know when they're going to happen. We're going to over the next year, we're going to see more and more of these positive announcements, and they're based upon a couple factors. I mean, obviously, Microsoft is going to buy all the electricity from 3 Mile Island. As somebody who lived through 3 Mile Island back in what was it, 1979, I vividly remember all the hysteria that surrounded that about that, and that plant. That one unit is coming back online. How incredible is that? Now, but what's interesting is that there's another facet of 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 underlying fundamental change happening in global uranium markets that people are not paying attention to. And it all has to do with these data center announcements. And that is going to be the introduction of the SMR, the small modular reactor. Now, what's interesting is that if you study the small modular reactor, which my partner Adam has been out to he spent days out there at TerraPower and NuScale and places like that, and we know Oklo and things like that, is that the SMR has a number of underlying fundamental factors that make it hugely superior to generating electricity from a standard high pressure water reactor. And the thing is, what's going to happen with the SMRs is that we're going to find out the SMR is going to wind up first. It will wind up displacing, standard high pressure water reactors as we progress between now and 2050. But in itself, it's going to be widely adopted by a whole slew of people that need reliable power. In this case, the data centers are the first movers in this. Now, what am I talking about? Why are SMRs so important? For example, we'll put NuScale off to the side because that's a little bit different because they're going to be using standard high pressure water um, uh, design. But like Oklo and TerraPower are using molten salt. And there's huge advantages of using molten salt over using water as a coolant for the reactor. For example, the thing with water, it boils at 100 degrees C. A reactor core will get up to 400 degrees C. So the only way you can prevent that water from boiling off is to put it under high pressure, up to 100 atmospheres of pressure, so that it can be used to remove the heat off the reactor and have that heat eventually exchanged in a heat exchanger to boil water. Now, the thing is that when to handle that high pressure needs an incredibly robust energy intensive system. You need 6-inch steel pipes. You need massive amounts of concrete to support all that. And what's interesting is that that's also you run the risk of if you have a circulatory failure or things like that, then all of a sudden you run the risk of a core meltdown, which almost happened in 3 Mile. It did happen in 3 Mile Island, and it did happen in Fukushima with no resulting release of nuclear radiation. However, with a molten salt boils at over 800 degrees C. So no matter if you were to lose circulation, is that what would happen is that the molten salt will never boil off. So, and also it doesn't need to be kept under high pressure. That the circulatory system can be run at atmospheric pressure. So you don't need the massive thickness of the steel. You don't need all the high specifications of the weld. You don't need all the redundancy in the circulatory systems. So the thing is that you can build a small modular reactor at an energy input cost that's fractionally less than a high pressure water reactor. Now, why is that important? Because generating electricity from nuclear power is by far the most energy efficient way that we can generate um, power/electricity. Basically, think of it this way: you take one unit in, you mine the uranium, you process it, you turn it into a gas, you enrich it, you put it in fuel rods. you build a massive nuclear power plant to convert the splitting that atom into heat, things like that. That 1 unit of energy puts out on the other side 100 units of energy. That's incredible. Now, for example, a combined cycle super high efficient natural gas plant, it's basically 1 unit of energy in that whole thing I just described, and you get about 30 units of energy out. So, in a world, if we were to switch over to 100% driven by nuclear power, we would be so much more energy efficient. We'd have so much surplus energy. Economies would be able to grow hugely over the next years that we adopted that. But we're not going to do that. However, get this, in SMR, that same analysis, because you use so much less energy to build the reactor because it can run at atmospheric pressure, you put 1 unit of energy in, you get 180 units of energy out the other side. It's an 80% increase over a standard high pressure water reactor. So, and it's safer because you don't have high pressure water and you don't have the risk of boil off if something happened to the circulatory system. So the thing is that it's a safer system that is much more energy efficient than the incredibly efficient high pressure water reactor. So I predict that once we get through the whole regulatory hurdles, which I think we will, especially now that all the tech companies are putting billions into push this thing forward, we'll be living in a world that in 2040 will be driven by the SMR with massive energy efficiency. So the thing is that this is a hugely positive fundamental story that no one has in their models of what it could do to demand. So that's how bullish the story can get. And so that's one of the most outrageously bullish stories that I can come up with. So
That's fascinating. I thank you
yeah,
for going through that. It's really good to, I know that was just briefly, but I felt like I really got a sense of what's coming there. I
yeah.
want to ask one more question on uranium, just over on the supply side. So you had mentioned these issues that Kazatomprom, major producer, is having, bringing new supply online, and that just makes me think further down the food chain to smaller developers, even explorers. What do you see coming? Are these, I guess, issues with bringing supply online? Are they things that will be ironed out in the future as we get further into this bull market? What do you see coming there?
Well, I think that it's interesting. The uranium bull story will be undone at some point, and it's not going to be undone on the demand side because the other thing about uranium demand, it's almost inelastic. It doesn't matter how high the uranium price. It's such a small part of operating a reactor that that it will never reach a point where we have to substitute out uranium for something else. However, there is a supply side issue. There's plenty of uranium in the world, and so the idea that at some point, as the prices go higher and higher, we'll go through a classic capital cycle, and it started right now. It started already. And so money is going to come into the uranium mining industry. We are going to develop new deposits. We are going to bring on new supply. And that will be what undoes the story. Now, the thing is that the question is that when is all that new supply coming? And like, for example, here's a good example. The US used to be the world's largest uranium producer. In uh, 1980, the US produced 40 million pounds of uranium. We produce zero today. Can we produce 40 million pounds again? The answer is probably yes, but the price has to be high enough and the capital has to flow in to develop it. But the thing is that going to happen? And a lot of those permitted uh, properties are now slowly coming back online, but it's going to be a million pounds there, 2 million pounds there. And we're talking about a deficit of 50, 60, 70 million pounds. It's not going to be enough. However, over time, by the early like 2030s, you get Arrow going, you get the Wheeler project going from Denison, you get a couple of these mines in Namibia, by Bannerman and Deep Yellow up and running. You get Paladin up and running. Yeah, you're going to have a supply side response, but that's still that's not going to happen for the next 3 to 4 years. But it's going to what it undoes the uranium bull market story. But we're not there yet, and we're probably not even close.
Okay, okay. I like that you also mentioned how this comes to an end instead of all the hype that's to come before that. So really good to go into that. And we said we would talk about copper as well, which you kind of hinted at earlier is a bit of a contrasting story with uranium. So
Yeah,
maybe just start by getting your broad thoughts there.
yeah, it's interesting. Obviously, uranium and copper have swung from, it's so funny, Charlotte. We were talking before that I first time met you was 2017, and all we did was talk about copper. And I outlined this very, very bullish copper story, which now has been 100% adopted by the investment community. Everyone is a raging bull on copper, and a lot of people are very, very bullish on uranium too. So, there's a lot of popularity that didn't exist in both these markets as little as 3 or 4 years ago. Now, what's interesting, there is, I believe, a big divergence that's happening between copper and uranium in the sense that the very, very bullish copper story, and the reason why everyone has become almost wildly bullish on copper is because of the belief of what the investment in the renewable industry is going to do to copper demand. Like, the Bible of copper bulls is the June 2022 huge paper put out by S&P Global called, let's see, what is it called? I've got it on my desk right here. It's called The Future of Copper. And in that, they say, oh, we believe the copper demand is going to go from 25 million pounds in 2023 up to 50 million pounds in 2035. So 25 million pound increase, of which half that increase is going to be renewables. Now, that's, I mean, that means that the impact of renewables is going to take the copper demand trendline growth, which over the last 25 years has been basically 3%, which is gone up from 1.5% because of China and what's happened in China. It's going to take it up to 6% per year. I mean, it's incredible. You're going to double annual global copper consumption between now and 2035 on a year-over-year basis. But what if it doesn't happen? Now, all that is based upon the adoption of renewables. Now, we're going all on and on about how energy efficient it is to generate power from nuclear power. It's just the opposite for renewables. It's the energy efficiency of renewables is, to put it bluntly, is terrible. Like, we're talking about nuclear power, 1 to 100, a photovoltaic solar farm. Basically, it's 1 to 5. And if you begin to talk about buffering it because of when the sun doesn't shine at nighttime and things like that, we're talking about reducing it to like 1 to 2. You go from, here's an industry that can solve all our energy problems with no CO2 to an industry that's going to create massive energy problems. And we're seeing it in Germany. Like, all you have to do is open the FT every day. Front page thing. Oh, Germany's economy is contracting. Volkswagen's going to close all these power plants. What is one of the major reasons? It's always embedded in there. Surging electricity costs. And why are electricity costs surging? Because Germany shut down their nuclear power industry that was producing power with energy efficiencies of 1 to 100 and replacing it with photovoltaic farms and windmills that basically, a windmill probably is 10 to 1, photovoltaic farms are 5 to 1, 100 to 1 down to 5 to 1. If you do that enough, of course you're going to have an energy crisis, which of course Germany and spreading to the rest of Europe does. So we're realizing very fast that renewables are creating more problems than they could ever potentially solve. And it's interesting too. I'm looking right here. Adam and I were in Australia 2 weeks ago, and I picked up the Australian, one of their national newspapers. In their business section, the headline is Origin, one of the big energy companies, exits hydrogen in net zero blow. It says green energy ambitions running out of steam fast. Why? Because people are realizing the energy efficiency of this is so terrible. So all that 17 million tons that S&P Global has projected between now and in 2035, is that realistic? Probably not. So you're going to have you're going to have demand disappointments in copper, and the underlying demand story in copper is going to weaken. I know this is trade stuff, and you're going to get a lot of pushback because we talk about copper and how we're developing a neutral to slightly bearish negative narrative, and people really freak out. They don't like to hear it because they're up to here with their copper investments. So you're gonna get a lot of pushback by this. But we're coming. We can put together a very neutral to slightly bearish copper viewpoint from here on out. So it's just the opposite with nuclear. It's strengthening. Copper is weakening. Uranium is strengthening.
That is very interesting. Yeah. And it is in contrast to a lot of what I've heard about copper. There's a lot of, well, in the short term, maybe not so much going on. In the long term, it looks really strong. So really interesting. What are the main, I guess, points of pushback that you get? Is there anything other that people say than the renewable story? Are there any other points that they push back on you with?
No, it's just vague stuff about demand's going to be really strong, that we're going to have supply problems. They're just parroting the consensus opinion. And as far as supply, there's another, this is a little bit looking to the future, but you can make the case that Robert Friedland in his Ivanhoe Mines with his whole iPulse technology, that could wind up being an incredibly disruptive technology in global copper markets, similar to what happened to the introduction of SXEW in the late 1980s, early 1990s, which of course no one remembers. I vividly remember that. I lived through the whole thing. So the thing is that from a supply side, is there going to be a potential change in copper supply dynamics? Because everyone has glommed on to the idea that we have problems in copper supply, which you and I talked extensively back when you interviewed me back in 2017, when people were bearish on copper. Now everyone's accepted it. So that's another thing. We're not there yet with Friedland and his iPulse technology, but it's something to really, really watch closely for a variety of reasons. So supply side, could we wind up with more copper mine supply? Back to Friedland again. He's got this whole Western Forelands things up in the DRC. These are huge new copper deposits that are now being discovered and things like that. Now it's not going to influence copper supply between now and 2000, the late part of this decade. But again, are we being too pessimistic about copper supply as well as we being way too optimistic on copper demand?
Okay, well, I think that definitely gives people a lot to think about when it comes to copper. And it's so interesting to see how your opinion has changed over the years. I'm glad that we went into that as well. I
Yeah,
think as we're
and,
wrapping it up, oh, go ahead.
and I'm glad. Like you remembered, we were in 2000. We wrote our first huge bullish copper piece in 2016, and it's great. It says renewables and the great upcoming bull market in copper. That was written when copper was $2.10, and now the copper's gone over $5 in this cycle, and everyone's become bullish. It's time to think about how could this bullish narrative be undone.
I think that makes a lot of sense. I think before I let you go, one of the points that is in the quarterly report is, I've honed in on what you've had to say about gold, precious metals, uranium, copper. But overall, I think one of the takeaways is that we're heading toward this larger commodities bull market. So anything you would add there? I know another key point is getting in ahead so that you don't miss it.
Yeah, and I think that investors today, just like I said, you should own gold today, because what table do you want to sit at that dinner party in the last week of December 2029? Do you want to be ordering champagne, or do you want to be sitting there wringing your hands and staring at your cold beef stew or whatever? Now, it's the same thing with hard assets. Hard assets are today as cheap as they've ever been relative to financial assets. And the funny thing is, just like they were in the late 1960s, early 70s, just like they were in the late 1990s, and they are today, and we have not begun this bull market yet. I think gold is telling you that the bull market is about to start. So you should own a significant part of your portfolio should be invested in this area. And you know what? No one can do it. And I certainly, on an institutional basis, because we talk to a lot of institutions, they understand the story, but can they do it? Absolutely not. But they will. But you don't. You are being given the opportunity today to do this. It's not popular. You're not going to go, to cocktail parties and talk about how much Nvidia you own and how much Microsoft you own and things like that. But what table do you want to sit at in the last week of December of 2029? And you're making that you can make that decision today. So you in even though natural resource stocks have been pretty good performers over the last several years. You haven't been left in the dust. However, the best is yet to come. It hasn't even started.
Okay, I think that's a great place to wrap up on. And I love the dinner party visual. So thank you so much for coming on to go over all these topics. This was very informative for me.
Okay, Catherine, it's great to reconnect. I vividly remember our great conversation in 2017 where we talked all about copper. And thank you for having me on. I really appreciate it.
Of course, really hope to have you back again, hopefully sooner this time. Once again, this is investingnews.com and Leigh Goehring with Goehring and Rozencwajg. Thank you for watching. If you like this video, make sure to hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below. We'll see you next time.